My name is Larry Goldstein. I'm here to present one of 6 programs that are being offered as on-campus training and development for the community. There are handouts that you were given, and 2 of them have numbers in them. And there was some confusion early on because people were trying to reconcile what they know about Cal State Fullerton with the numbers on those pages. There is no relationship. These are, well, they're not fictitious universities, but they're not CSU Fullerton. So don't try and draw any conclusions from that. The slides, which have changed, not dramatically, but they keep changing as I go through these presentations because people say things that trigger a way to clarify things. And so I'm making changes. I'll explain about the book in a minute, but there are 50 copies of the book that have been purchased by Finance and Administration to make available on a lending basis. So if you have an interest in reading the book, you are welcome to let Jofel Maruzzo know that you would like a book, and she will sign one out to you. And then lastly, I have more slides than I can cover in the amount of time we have, and that is by design. It's not by design that I can't cover them, it's just that we wanted to make sure we convey this information. The slides, for the most part, are self-explanatory, and reading them will be very understandable to you. There are things that I want to add to the slides, but I will skip some slides in the for the benefit of time, under the assumption that you came here for a 1:15 session that should end at 3. I don't have anything to do tonight, so if anybody wants to stick around and have a dialogue, I am happy to do that. But I will try to end right at 3 for you. But I would much prefer that you ask me your questions or make comments or share your opinions. Ron Coley introduced me the first session I did, and I love the fact that he encouraged people to ask questions. And he also said, if there's something you know and you disagree with Larry, let him know that. And I've had a couple people who've had divergent views from mine, and we've figured out why that is and kind of reconciled in some cases and not in others, and that's fine with me. So there are 5 other courses, 3 of which have budget as their focus. One is called Budget 101, Principles of Budgeting, and Budget Administration, How to Manage the Departmental Budget. They cover various things. They cover things like the state process for budgeting, how that manifests itself at CSU, Fullerton. Then there's the one about managing a departmental budget, which is pretty self-explanatory. There are 2 other programs. One is about direct and indirect cost allocation principles, and another on space and facilities database. They have budgetary implications, but that's not their primary focus. So I'm encouraging you, if you have an interest in these topics, to participate in these programs, because the goal, as I understand it, the president is concerned that people don't understand enough about how resources are managed at the university. And he charged the interim vice president, Ron Coley, with doing something to make it more transparent. That was translated down to Lale Grayley, and she started to design these programs. I'm being brought in because literally I did write the book. There are 2 books in higher education budgeting. One is focused on the department and primarily auxiliary enterprises. It's a very good book. I cite it in my book. But mine is the comprehensive college and university budgeting designed for academics and others who care, faculty and academics who care about budgeting. It's a very high level. It is not going to get too specific. In fact, it probably won't get specific at all to CSU, except as I've learned things while I've been here. So that's not the intention. I hope nobody's disappointed by that. I've taken the whole book and synthesized it down into 4 categories of what I think we can cover together. And I put them in these broad categories: alignment, resource categorization, resource management, and finally assessment. I make the disclaimer that everything I know about assessment fits on one slide. And so when you see that slide, you'll know we're at the end of the presentation. Alignment is pretty critical. I think it's one of the major keys to achieving institutional effectiveness. If we don't get alignment, you can be successful, but it's by luck, not intentionality. And so I'm going to talk to you about that to start. I'm a finance guy. I don't apologize for that. That's been my career. But I will tell you, I don't think money should drive any decision on a college campus. I don't think there are many decisions that you should ever make on a college campus without considering money. But you're not a business with a bottom line of for-profit or whatever. So money is a factor to take into consideration, but it shouldn't be your driver. Planning is where you should begin. And a budget is not a plan. A budget is the financial manifestation of a plan. So when I talk about alignment, I'm talking about the need to align planning, resource allocation, and assessment. Now, you'll sometimes hear the phrase integrating planning and budgeting, and I don't subscribe to that theory because they are disparate processes that don't lend themselves to being combined or integrated. I'm going to talk to you about 3 levels of planning: strategic planning, infrastructural planning, and operational planning. Operational planning does not live large in higher education, unfortunately. People, in fact, I have frequently done programs at national conferences and regional conferences, and I never fail to ask, how many people are doing operational planning? And I get lots of hands come up. And I follow up and say, great, how easy would it be for me to get a copy of your plan? Oh, we'll send you our budget. A budget is not a plan. The plan precedes the budget. And so I'll kind of try to drive that home. I'm talking about integrating planning in the context of you've got academic plans, you have facilities plans, you have strategic plans. You probably don't have operational plans, but I'm going to encourage you to do that. They all need to integrate with each other. And by that I mean universities are complex organizations. It's very hard for everybody to be pulling in exactly the same direction. So I'll use the points of a compass. If the institution says we are heading for 75 degrees, that's clear, it can be explained, and what 75 degrees mean. But because of the diversity of the institution and the complexity and the variety of different things, you may really be going between 60 and 90 as an organization. And that's truly integration, that may be alignment. What would not be alignment would be to have someone going 270 degrees versus 70 degrees. Going in the opposite direction does not reflect an intentionality to align. So there are a couple of things that come along with alignment. First off, sharing and coordination of a few things. Information is critical and perspectives are critical. You're a complex organization with lots of moving parts. And depending upon where you work and what you do for the university and for your various stakeholders, you have a different perspective from other people who are doing equally important things. The only way that you will achieve the ultimate objective of being as effective as you can within your resource limitations is if you have an appreciation for all of those different perspectives. So the only way to get that is to structure to bring those perspectives into the processes. Similarly, information needs to be shared. We're going to talk a little bit later about resources, and we can argue whether information is a resource. I don't classify it as a resource for my purposes, and I'll explain why later. But that doesn't change the fact that information has to be coordinated and shared, and it won't have value if it's restricted to where it's released. Finally, you can't have alignment without having execution and action taking place in support of the plans that you've established. So if we're going to talk about alignment, that's the way I would like you to think about it, is that we are not all doing the same thing. We're not all trying to be the same thing, but we're all acting in support of the same objectives. I have a specific approach that I've followed as a consultant to strategic planning when I facilitate it. I believe it's a one-year process that relies on a strategic planning task force that's large. An institution your size, it would surprise me if we could do an effective job of strategic planning without a 40 to 50 person task force. I'm not afraid of large meetings. You facilitate them, you manage them well, and you can do good things. You need a large group because that's what it takes to get access to all of the different perspectives that we want to take into consideration. The other thing I'll tell you is, because this is higher education, if I were establishing a planning, or if I were facilitating planning here, my advice to the university would be, I want a planning task force where 55% of the participants are faculty and 45% represent other activities. If I worked in healthcare, I'd want 55% to be doctors and nurses. But if we're an academic institution, I'm not going to be successful in facilitating your strategic plan, and you're not going to be successful if the faculty don't embrace it. And they won't embrace it if it was handed to them. They have to be influencers in that process. You can't have every stakeholder group represented, but you certainly can engage every stakeholder group. And that's part of the process of strategic planning, is to gather information and engage the various stakeholder groups to get their perspectives represented in the plan. I believe in 5-year horizons for strategic plans. I think as part of that planning process, not at the beginning of it, but midway throughout that process, you decide what our strategic priorities are, the 5 to 6 major goals, and you establish the vision at that point, not at the outset. The vision for the strategic plan is, how do we want those 5 to 6 areas to look differently 5 years from now? What is the picture we're striving to create? And we need the whole institution working toward that. We have to identify success measures at the outset. And I'm a big proponent of quantifiable success measures, although I'll acknowledge you can't always find them. Sometimes you have to come up with surrogates for a number. But strategic planning is the top level planning in any organization. I contend that in over 40 years of working in higher education, I've only done one thing that was original. Everything else is just stuff I learned from other people and applied. There was no concept of infrastructural planning before I started thinking about how difficult it is to be responsible for activities and resources in a college or university environment, and to have a strategic plan that only identifies 5 or 6 things. And you have all these different activities. Sometimes nothing in the strategic plan references them. So I was finance, I had accounting, I had facilities, I had at different times IT reporting to me. And there were times where none of that was mentioned in the strategic plan. So how were we to know what we were supposed to be doing, and how was the rest of the university or college supposed to know what they were supposed to do that we had influence over? And it's through infrastructural plans. So infrastructural plans have nothing to do per se with infrastructure. The roads, bridges, sidewalks, buildings, all of that stuff, that's needed here, and we'll talk about that. But when I use the term infrastructure, I'm talking about the entire set of foundations that need to be in place to get anything done here, and to do it in an aligned manner. And so they're divided into 2 broad categories: programmatic infrastructural plans and support infrastructural plans. They tend to have, so strategic plan is a 5-year cycle. These tend to have 2 to 4-year cycles. Something like information technology, we'll talk about that in a second, can only have about a 2-year cycle because it's too dynamic a field, things change. But the academic plan should have at least a 4-year cycle. They tend to have 4 to 5-year cycles. Part of that is the idea that most of your degree programs are intended to be completed in 4 years based on semesters and that sort of thing. However, we know that most students don't complete in 4 years. The programmatic plans, since this is a university, in my mind, the first one should be the academic plan. It describes what we're trying to accomplish academically, who we're trying to serve, how we're going to serve them, who will be providing those services, what our priorities are, what forms of pedagogy are going to be most important for our institution, although I want to be clear, that doesn't mean that everybody can rely on those forms of pedagogy. Other disciplines may need different things. One plan you don't see up here, and it could very well be a separate plan here, would be research. But if you don't have a separate research plan, you would expect it to be included in the academic plan. I would tell you that the person primarily responsible, and actually ultimately responsible for the academic plan, is the provost or chief academic officer. When I say responsible, I don't mean they write it, I mean they are responsible for ensuring that such a plan exists. Excuse me, the second most important plan in my view would be the student engagement plan. So we know what we were trying to accomplish academically, but what is the experience we want our students to have? And you'll realize if I say that the provost is ultimately responsible for ensuring an academic plan, that there isn't a single person who can be ultimately responsible for all aspects of the student engagement plan, because part of student engagement happens in a classroom or a lab, but another part of it happens in the library, another part of it happens in the dining hall, another part happens in intramurals, another part happens in student government. So someone has to be identified as the person who's responsible for bringing it to fruition, but you could decide who that would be at this institution. When I first developed this concept, I didn't think in terms of learning resources. The term that was on this slide, the first time I created the slide, was library. Because back then, library was understood and it had a major role. I'm not saying it no longer has a major role, but when we heard library, we knew what it meant. It meant books, it meant manuscripts, it meant other artifacts, and nobody was thinking about it being predominantly digital and transferable at the speed of light. And that's all changed. I think within higher education, I think library has gone through the greatest transformation of anything in modern times. And it's still evolving. We're not there yet. But it's not just the library. It's various types of learning centers. It's tutoring centers. It's writing centers. It's all the support systems that help students in their capacity as a student in a curricular way or a research way to be successful. So there's a plan for that. The reason these plans are so critical is that other people around the university need to know what's being planned so they know what they should be doing. Now, you can't do an academic plan, a student engagement plan, a learning resources plan without knowing what the support environment's doing. So just bear in mind that I'm going to talk about those plans in just a second. There are other plans. Auxiliary Enterprises Plan is that plan that deals with the range of activities that represent many businesses operated by the university for the benefit of students, faculty, and staff, and occasionally or incidentally the public. They operate as businesses, they must recover their costs, and they can't get by with just breaking even. They have to generate a surplus to manage their expansion over time. If they are closely tied to the academic mission, they should be considered a programmatic plan. If we're talking about a community college that has a bookstore that provides the bare necessities and maybe some vending machines, I probably would think of that more as a support plan. But I come from universities where the auxiliaries were closely tied into the academic mission, where the bookstore brought authors to campus and coordinated with the faculty who was coming and who would be available to lecture, in addition to doing a reading and a signing and that sort of thing. Dining halls that actually would do international cuisine in support of some of the things that were happening in classrooms. When those things are taking place, I was at the University of Virginia when they established their first honors college, and they established it as a residential facility. They literally took over a series of first-year dorms and turned it into a residential honors college with faculty living in the dorms with the students. That's pretty darn connected as an auxiliary enterprise. So if it is connected, it's a programmatic plan. If it's not, it's a support plan. You're a Division I institution that makes a significant investment in athletics. Whether we like that or not is irrelevant. It is a fact. And if you're spending that much money in an area that is that influential and impactful for students, then it's a programmatic plan. So you would expect to see it on this list. If we were at an institution that maybe didn't have a major commitment to athletics, or possibly a Division III institution that doesn't invest much resource in athletics, doesn't grant scholarships for athletics, maybe it would be a support plan or it would be buried in student engagement. But here, I would argue you need an athletics plan as part of your programmatic plans. When we switch to support, if my bias is that the academic plan should be the first plan programmatically, then the first plan from a support perspective is enrollment management. What students are we trying to attract? How are we going to attract them? Who's going to work on attracting them? And how much are we willing to invest to get them here? That's the first plan, in my view, of what you should be doing from a support perspective. The second plan, again, so I should stop saying in my view, because this stuff is all my view or I wouldn't be presenting it to you, okay? But the second one is advancement. And I define advancement very, very largely. So frequently when you think of advancement, there's a tendency to think just of fundraising, and that's clearly a critical element of advancement. But I define it much more broadly. Anything that enhances the image of the institution or impacts your ability to be more effective as an institution, providing resources, either as financial resources or other types of support, is advancement. So fundraising, without question, development is advancement. But so is community relations, so is state relations, so is donor relations, governmental relations, I said state, governmental, alumni relations. All of those activities need to be coordinated. And it's particularly important in an institution like this one where you've got an athletics program, a big-time athletics program, because one of the things you want to guard against is you don't want a dean approaching a significant donor for major support on a project only to discover that they lost the opportunity because the athletic department got them to sponsor an event. So that all needs to be aligned and integrated and coordinated. These two, facilities and information technology, honest to goodness, 2 years ago, if I were presenting this, I'd be saying different things about it because there were things we didn't know prior to the pandemic. I'm just curious, how many people in the room didn't work on campus throughout the pandemic? Did anybody continue to come to campus every day? By choice or requirement?
Yeah, both.
Okay. So what we find is across higher education, this is not a bad ratio. 1 out of 20, 1 out of 25 people came to campus because their jobs could not be performed. I happen to be the parent of a child who's a project manager at a university. She could work remotely 1 day in 10. I'm sorry, 9 days in 10. 1 day she had to be on site to look at the progress on the projects. Her husband is the trades overseer for all plumbers, electricians, carpenters, et cetera, at the same university. He worked every day that the university was conducting operations. That's the nature of what we learned, is that there's a lot that we can do without ever coming to campus or only occasionally coming. We don't know yet where facilities and technology are going to shake out after what we've learned, but it's not going to be what it was 2 years ago. So I'm anxious to see what happens with how we operate. I've worked with institutions, some for years, that have relied on remote employment because they're space-bound and they can't build. And yet the demands that are being created or the service that they're required to provide dictates that space be used for certain things. This last one is a bit of a catch-all. The administrative plan could cover a lot of different things, and I just put it up there to give me a chance to talk about things. So if you're coming up on renegotiating your F&A rate, that would be covered in an administrative plan. If you're engaging in a self-study for reaccreditation purposes, that would be in there. Another example might be if you've got a concern about compensation equity across the campus and you're going to do a study to see whether there's any built-in discrimination or misalignment of resources, that would be one. I did a presentation of this material at a national conference, and I was given enough time to have them do a small group activity. I did a couple of different activities, but one of them was around this stuff. So there were tables like yours, there's 5 or 6 people at each table, and I said, take 5 minutes and have a conversation. Ignore the 10 that I've given you, but tell me what plans you would have. In 5 minutes, they identified 132 plans beyond the ones you've seen that collectively, not one university, but collectively they thought they needed, because this idea of, well, I'm going to be creating these plans, but I can't do that if I don't know what's happening in other parts of the university, nor should something like an academic plan be created if they don't know what I'm planning to do with respect to how we handle research overhead recovery or whatever it is. So 132 discrete plans. So one of the myths in higher education is that when you adopt a strategic plan, everybody stops doing what they were doing and they begin doing something different. That's just not true. The other myth is there is no Department of Strategic Plan that's going to get all that stuff done that's in the plan. Strategic plans get implemented by every person or nearly every person on campus doing something slightly differently every day toward your new priorities. So the vast majority of what you did last year or right before we adopted the plan is going to continue. There will be some new things added over a period of time. 5-year plans, if you're trying to implement them over 5 years, you don't start doing everything new immediately. Some things you do this year, some things you do 3 years from now. And the key is you will stop doing some things because they no longer support the agenda for the institution. And that's accomplished through operating plans. So the goal we're trying to achieve is to identify in advance of resourcing those things that we want to do. What were we doing last year that we want to continue doing? What were we doing last year that we no longer want to do, don't think it adds value? And what do we want to do that's new, either driven by the strategic plan or driven by infrastructural plans? So infrastructural plans have 2 to 4 year cycle. Did I say that already? Okay. This is like my 8th presentation, so I apologize. I may repeat, I probably will leave some stuff out. But the key here is I need the whole university working in concert toward the strategic plan, but it's going to affect different parts of the university differentially, and we need to be aware of that. I haven't talked about money very much, if I've talked about it at all. I did say we don't drive decision-making by money. However, we do have to consider it, and all plans. So if you don't have the discussion about money, if you don't resource plans, they're really not plans, they're dreams. If you're going to implement them, you need to resource them. And we need a financial plan that supports and aligns with all of the plans that I've described. So for instance, if I'm going to really do an effective job of planning, there are certain things I need to understand very deeply. One of them is revenues. Revenues are critically important if you're going to be successful. So I need to know how we generate revenues, who generates revenues, and where they come from. And I need to understand the fact that, wow, certain programs are really good at creating revenues. Other programs are a little more challenged. And some things that we do on a campus contribute nothing to the generation of revenues. Secondarily, I want you to know that there is no dollar of revenue that's ever been realized by a college or a university that wasn't preceded by the incurrence of an expense. You expend resources to make resources. It doesn't work the other way around. So I need to deeply understand revenues. I need to deeply understand expenses, and I better understand net revenues. And I need to understand which things generate net revenues, which things break even, and which things actually generate net expenses. Net expenses are a problematic concept because if you are spending more than you're bringing in, when you consider all of your operational support, so accounting interferes with this a little bit. We have operating expenses, we have operating revenues, but because you're a public university, there are three types of things that support operating expenses that we don't get to count as revenues for operations. One is your state appropriation, the other are gifts, and investment earnings are not allowed to be treated as operating revenues. It's prescribed. So we don't use the term operating revenues for this discussion, we use the term operating support. Those things that you deploy to fund operating expenses. If your operating resources are exceeded by your operating expenses, you have a structural deficit. When you have a structural deficit, the more of it you do, the more you lose money. The more you lose money, the quicker you are arriving at bankruptcy. It is inevitable. If you spend more than you bring in, you will go out of business. So I'm not saying we don't do things that don't generate a net revenue. I absolutely think we have to do things that don't generate a net revenue. There are certain academic programs that we must offer even though they cost more to mount than we actually generate in revenues. But we have to have enough of the other type that we cover those losses. So I'm proposing a 5-year financial plan tied to your strategic plan that incorporates the plans for infrastructural planning, and then it guides and is influenced by the operating budget and the capital budget. From this point forward, I'm not going to talk much about capital budgeting, but know that that's another aspect of budgeting that's critically important. It's the facilities acquisition or construction that builds out the campus. That's handled in a capital budget. It's not handled in an operating budget. This is a visual depiction of everything, including the capital budget. We start with a strategic plan. These darker bubbles are the support plans I was talking about, and the lighter bubbles are the programmatic plans. And notice there is a direct line between each of them. If it wouldn't muddy the visual too much, I'd have lines going all across directly between some of these because they're so integrally linked. But what I'm trying to convey with the financial plan is that's kind of the glue that holds the whole thing together. It's the financial plan that contemplates the operating budget, the capital budget, what we're doing under strategic planning, what we're doing under infrastructural planning. It's all covered in the financial plan. The financial plan has a 5-year life and it rolls every single year. We renew it every single year. It goes out for another 5 years. This is the slide that I want to use to get you to think about the concept of integrated planning. And what I'm trying to show you is strategic plan starts at the top, infrastructural planning, and then these curved arrows are all the aspects of integration. Strategic planning drives operational planning. Strategic planning drives infrastructural planning, and infrastructural planning drives operating planning. But this is the alignment I was talking about. So everything except capital that happens on a campus is reflected in your operating plans. Should be. Everything should be addressed in your operating plans. Second, nothing gets done if we don't resource it. So the operating plans lead to the resourcing. From resourcing, because we did a good job of planning and saying what success will look like and identified the milestones at which we'll conduct the assessment, we can say whether these plans were solid and the resourcing is appropriate or are not. And so one thing I want to highlight is these are double-ended arrows because unfortunately it isn't linear. We don't plan, resource assess, and start over again. We frequently plan, we do the resourcing, we do some assessment and realize, oops, something was wrong with the plan, or something was wrong with our resourcing. So let me give you an illustration of this. Let's say that we had a major multi-unit initiative at the university that was going to consume significant resources. We expected it to take 1 year, and we decided it was going to be 6 months before we'd be able to do the initial evaluation of it. So 6 months arrives, we're 50% through the period where we expected to complete this. We have spent 80% of the resources, and we've achieved 20% of the objective. That isn't that uncommon in higher education, unfortunately. What's equally common is that when that happens, irrespective of how important it is, people will put the extra money in it to keep going without asking the question, wait a minute, if we've only accomplished 20% with 80% of the investment, what's it going to take to get us to 100%, and is it really worth it anymore? Are there better uses for those resources? There's not a lot of discipline in higher education about stopping things. Michael Porter was a Harvard professor who said, a tough decision is deciding what to do. A tougher decision is deciding what not to do. Without question, the toughest decision is deciding to stop doing something. And we just don't have that discipline in higher education as a general rule. So my argument would be, if it really was critically important, we bite the bullet and acknowledge we did a poor job of planning and resourcing this. Let's fix that now and continue doing it if it's that important. But don't continue doing it just because we spent so much money toward it already. Because in my scenario, that's going to cost you way more than you thought it was. And you have to know you're going to get the return for it. Any questions at this point? Okay. I want to talk about resources and how they're categorized because it's not common knowledge. There are only 5 things that matter or should matter to you in terms of resources. It's people, money, space, technology, and equipment. Because everything that happens in a higher ed organization, and I would argue in almost any organization, requires some or all of those 5 things. So what we know at Fullerton, equipment is not budgeted centrally. You all decide on a decentralized basis what you need in terms of equipment, and you figure out how you're going to do that. You may get some central support for it, but it's controlled at the unit level. But all these other 4 are controlled in 2 places. They're controlled centrally and they're controlled at the unit level. Dollars, position, space, technology. My argument isn't so much where they need to be controlled, is that they need to be managed somewhere. And here, most everything gets managed at the decentralized level and at the central level, except for equipment. And I think that's as it should be. It's a shared responsibility. And with alignment, we have to make sure that our resourcing is following our planning. We need to manage to ensure that we can do that. I want to talk about the resources and how they get classified, and therefore what you're able to do with them. So we don't use the term equity or net worth when talking about colleges and universities, but it means the same thing as it does in the for-profit sector. The idea is that we have assets, things we own that have a financial value. We have obligations that absolutely can be stated in financial terms. And the difference between those two, which is our equity, is known as net position for public colleges and universities. And their net position has to be reflected in 4 different categories: restricted non-expendable, restricted expendable, net investment in capital assets, and unrestricted. And there's 2 flavors of unrestricted. So let's talk about restricted net assets. What the term restricted means is there is some limitation on the use of that resource. And in higher ed, publicly, those limitations come from one of 4 places. Donors will restrict your use of resources. Government can restrict your use of resources. The example I like to cite is the state of Wisconsin funds higher education partially with tax dollars. And they have a requirement that no tax dollars be used in support of research. Any research that's conducted by the institutions in Wisconsin will be funded either by sponsors or donors. It will not come from taxpayers. Now, we might disagree that that's a sensible thing to do, but that's their rule. The 3rd category would be laws. And so in California, you get a state appropriation every year. That's a law. Your legislature actually decide, they create the law, the governor signs the law, the money comes to you through the CSU. Some of it you get directly, but the appropriation part. The appropriation you get has two flavors of money. Some of it is unrestricted, and you can use it for any legal purpose at the institution. And there are fights and arguments about who gets to spend it, but it's there and it's available. There are other resources that are restricted and must be used in a certain way, or conversely, can't be used in a certain way because of a restriction. So those are the four ways. Notice they're all external to the university. I'm sorry, I didn't mention contract. You got a residence hall that's being built over here that eventually will be financed through bonds. When you issue those bonds, because it's a revenue generating activity and it's called a revenue bond, there will be a clause in that bond that says the first X of the revenues generated from the rents will be put aside to preserve the building. It's a requirement. You won't be able to spend any of those dollars. The first group you put aside. Everything else is available for operations, to clean the building, to pay the utilities, to do all the different things you need to. But by having a bond issue, signing a contract to repay the bonds, part of that signature says we will take care of these buildings for the life of the bonds. Now, there's no requirement to take care of them beyond the life of the bonds, but it's pretty stupid if you don't. So you would probably create those reserves. But my point is those reserves would no longer be restricted after you've repaid the bonds. So the biggest category of restricted non-expendable resource is your endowment. You accept a gift from a donor. A donor wants to give you $1 million to support anything. Pick your favorite thing. $1 million to support your favorite thing. But the donor says you can't spend the principal. You can invest the principal and you can generate earnings. Earnings would look like dividends, interest, rents, royalties, things like that. And you should invest it wisely so that it becomes more valuable over time. And we call that delta, the difference between what it was worth when you got it and what it's worth today. If it's increased, we call that appreciation. And the law that governs the management and use of endowment says it's prudent to spend a portion of the appreciation. So in my example, let's say it was $1 million endowment. These numbers are not real, they're just illustrative. But let's say that you earned $30,000 of dividends and interest. All the dividends and interest are available to be spent. It's not prudent not to spend them. But then you get appreciation that amounts to $50,000. It's worth $50,000 more at the end of the year than it was when you first got it. So we have to decide how much of the $50,000 do we want to make available. And a prudent, actually a kind of an excessively prudent decision might be to say, we're only going to use 30,000 of that. I'm sorry, 10,000 of it. So I'm going to disperse to whatever department or activity you wanted to support with your endowment. I'm going to give them 40,000 in the next year's budget to be used for that purpose. And the other 40,000 of appreciation that I'm not spending gets reinvested in the endowment and will continue to grow and contribute. And over time, I will spend income and a portion of appreciation as we deem it prudent. The average endowment spend among higher education in our country is anywhere between 4.5% to 5.5%, but there are some definite outliers. So the principal can't be spent, but the income and a portion of the appreciation can't. Restricted expendable net assets always can be spent, but they have to be spent for the purpose for which they were given. So a gift that comes to you, if someone gives you a gift of $25,000 to buy resources for the library, they can only be used to buy resources for the library. And there's some latitude in some of these things. If you were to have an endowment, a gift that said this is for faculty support, you might be able to use it. If it was a recurring gift, you could use it for salaries. If it was a one-time gift, you certainly couldn't use it for salaries. But you could use it for travel. You could use it for the faculty member to subscribe to digital resources or whatever. It's pretty flexible, but it has to be used for that purpose. Endowment income is usually subject to the same restrictions. There's a third category of restriction that's relevant for public colleges and universities, and that's sponsored agreements. By their nature, sponsored agreements are restricted because you have an obligation to spend the money in accordance with the budget you submitted and was approved by the sponsor. So, but you can have restricted resources for any purpose. Now we get to capital. I don't want to spend a lot of, sir.
Actually, can you just go back to the last slide? So is the idea behind separating the income and appreciation that it is, now is that going to be different for every gift, or is that to account for inflation and so you have some systematic rule for that?
So the question is, this idea of separating principal and appreciation and that sort of thing will be different for every gift. There's a couple of answers to that. One, you have a policy that governs all endowments, unless you agree to accept a gift and deviate from your policy, which most institutions are loath to do. It has to be a really big gift before you would say, look, this is our pooled endowment and everything is subject to this set of approaches, but if you're giving me 10 million bucks, I'll make an exception, okay? That happens occasionally, but it's pretty rare. But what we usually do is we take all those endowment gifts, we put them in a pool together, we invest the whole thing, and we set a rule for all of it. And we would say, it's very typical that the first year an endowment exists, nothing gets spent because it has to earn. But in the second year, you would own a certain number of shares and the university would calculate how much it wants to distribute in the form of earnings. And it would be a percentage, like I said, somewhere between 4.5%, 5.5%, and every share would be entitled to the dollar value that represents that percentage. And you all, someone even mentioned this to me, but I would have expected it anyway. For every endowment account, you have a distribution account, and that's where the money goes into, and you charge your expenses to the distribution account, not to the endowment. Does that address? Good.
Yes, yeah.
Thank you. So I don't want to I'm not trying to turn you into accountants. I just want to help you understand this stuff. You've got a massive investment in physical assets, and you have a modest investment in intangible assets. And accounting rules require that you do something that we call capitalize. When you build a building, you don't get to treat it like a salary and write it off in 1 year. You capitalize it, and you recognize the consumption of the asset over time. So if we say a dorm is going to last 20 years, then 5% of its cost becomes a charge against this year's budget. And the next year, another 5%, and the next year, another 5%. The most common intangible asset that colleges and universities deal with that gets capitalized is your investment in major software systems like PeopleSoft. So you embarked on a PeopleSoft implementation some time ago. You assume the initial iteration of that is going to be for 10 years, and then you'll have to replace it or upgrade it or whatever. So 10% of its cost gets charged to operations, and you have to cover that through your budget. So now I've got accumulated, oh, and by the way, that's called amortization. The first one is called depreciation. So I've got the purchased assets, capital, physical, intangible. I've got depreciation, accumulated, and depreciation and amortization that's been accumulated. And then because it's in our nature to do this, I've also got long-term debt that relates to the assets. I take the purchase price, the accumulated depreciation and amortization, the debt that is still outstanding, and the difference is our net investment in capital assets. It's very important. You cannot spend it. You cannot spend a building. You can't spend an endowment, you can't spend a building. So you can't walk into 7-Eleven and say, I got this piece of equipment, I want to trade it for a Slurpee. It's not going to happen. You could sell it and get the Slurpee. You could do that, okay? But the reason we want this recognized is it's part of our net worth. It's part of our savings. It's part of our value. When you want to borrow money to build a building, you can use the value of your property to substantiate that asset, that acquisition of a loan. Now we get to the one that's of most interest to people, and that is the unrestricted net assets. There's nobody outside the institution telling you what to do with these resources. And again, the only barrier you have to get over is use it legally, not a high bar to fit. Financial resources, but it comes in two flavors. We have some that we've designated. And when you designate a financial asset, you've essentially done the same thing that an outside party has done to create a restricted asset. We're only going to use these resources for this purpose. The key distinction between the restriction and the designation is created by the senior leadership of the institution, and what they designated, they can undesignate. So they don't always have to stay designated. But I've given you 3 examples of how designated assets are used. First off, you start your fiscal year in July and you start your academic year in August, September-ish. But you've got people on contract who are coming to work in July. You're buying equipment, you're buying supplies, you're doing a whole bunch of things that you're spending money for before you've received the money in the form of tuition from students. So we need working capital set aside. It's just another form of reserves. It's just working capital. We're going to use it to finance our operations until we collect the tuition and fees. Facilities renewal and replacement. Remember I told you you're going to have some restricted money to take care of the dorm that's bond financed, but this building, I don't think this is a housing building, it's part of the footprint, but do they house people up here? If it's not, let's just say it's an E&G building, it's a general building. We need to take care of its roof when it goes bad too, so we create a reserve from designated funds. The third one is rainy day funds. We know that stuff is going to happen. We want to protect ourselves against the need to do mass layoffs when there's some sort of financial crisis. So we put money aside, just as you do, for savings. All three of those can be calculated formulaically. You decide what percentage of your operation you need to have cash available for, what percentage of your replacement value of all your facilities you want to anticipate having to use in a given year. And finally, given the magnitude of your operation, what would we want to have on hand to prevent us from having to react in a kind of a knee-jerk way if we run into a financial problem? So those are all formulaic, they're designated, you can undo them, you can add to them, it's all whatever senior leadership wants to do. The last category is usually pretty small, but if you're successfully funding these three and reserving those dollars, this last category is everything that's left over. Every financial resource that's unrestricted, that hasn't been designated for something else, is available for current use. And so you might choose to use it. If you do that, the likelihood is you're going to spend deficit. If that's approved in advance, if you plan to do it, I see no problem with it. Unanticipated deficits, short of a catastrophic event, is basically a leadership failure. You weren't willing to make the tough decision to stop spending before you ran out of resources, ran out of budget. But there are times when you maybe don't want to tap the rainy day fund yet, and you would tap these reserves and you would spend those. That's totally appropriate. They're unrestricted, they're undesignated, why not use them? I'm going to guess most of you are already pretty familiar with this, but there are different types of revenue and they come from different places. You have a handout that describes this. I'm going to go through it real quickly. I don't know why I chose to start with students, but I do. Tuition and fees is the primary source of revenue that you get from students. Then you turn to governmental sources, and there are two main governmental sources for the revenues that you receive. The federal government gives you two types of revenues, only they don't give you much of one of them. Federal appropriations tend to primarily go to land-grant institutions, secondarily to historically black colleges and universities, and then finally what's left over comes to Hispanic serving institutions and tribal colleges. And so you qualify in the past, apparently, at different times, for some modest Title III funding, which is the Hispanic serving. It's not major to you, it's not make or break, but every dollar is helpful. The big thing that you rely on the federal government for are grants and contracts to support sponsored research. They're not the only provider, but they tend to be a major provider. They provide resources in two flavors. Direct cost reimbursement, which is basically the money that the principal investigator controls spending of. They decide, they make a budget proposal and they say, we're going to put so many people on salary at this amount, they're going to work this much on the project, we're going to have this much in the way of supplies that are not considered generic supplies, they're specific to the project. We're going to have to rent some space because there's no space on campus to do this and the sponsor agreed to it, so you have some rental costs. All those direct costs that only are incurred because you got that project. Then on top of that, the federal government recognizes through a facilities and administrative rate agreement that you're supporting the project beyond just the direct costs. And though faculty don't like to think about this, they are burdening the institution with extra work. And so the federal government reimburses a portion of that. State government operates exactly the same way. They give you an appropriation. Theirs is much more significant than the feds do for you. They also do grants and contracts. They are much less significant than what the feds do. And they're frequently for the same purposes, although what you'll discover if you do deep analysis on your sponsored programs that come from the feds versus what you're getting from the state, many things that the state will finance are considered other sponsored activities. It's not research usually. It could be training, but it's usually not research. They do something else, but it doesn't happen in California. I'll just mention it real quickly. Some states decide that they will bear costs at the state level and not pass them on to the campuses. They literally take the money off the top, and it can take the form of employee benefits, repaying the debt that's been incurred to finance construction, and in some cases it's even facilities costs. Some of them are carried at the state level. Okay, We did students, we did government, now we're going to do private. Two main forms of private, the first one being individuals. We put this first because we want our alumni to support the institution and we want individual donors. So we get contributions from private individuals, and they take two forms, cash and in-kind. A cash, you would all know what a cash donation is, but an in-kind donation is where they're giving you something that's tangible, could be property, could be equipment, could be software, and they get credit for it for its value. They also occasionally will qualify to contribute services that you would recognize in your financial statements. You would count it as revenue, and in all likelihood, you would count it as an equal expense. You don't make money off contributed services. There is an occasional situation where you might have contributed services in the form of a physical structure. Someone might come and agree and be approved to build a facility for you, and they don't charge you anything for it. You don't get an expense then, you get an asset. So you would have a revenue equal to the value of the building, and the value of the building would become an asset, and you would start depreciating that building. Corporations and foundations do some of the same things, but we don't get grants and contracts from individuals. We do from corporations and foundations. So they make contributions, cash and in kind. They contribute services occasionally. They also award grants and contracts, foundations and corporations. The one thing that they have in common with each other, and it varies at level, but they don't reimburse fully the way the government in theory reimburses. The foundations and the commercial entities that support research and other sponsored activities usually have a very low cap for how much they're willing to reimburse. Next category, we've talked a little bit about endowment income. There's another category of investment income. Endowment is that long-term pooled set of resources that you're investing for the long haul. Investment income comes from idle cash that you invest either short-term or mid-term so that you generate a modest amount of earnings, and that becomes typically it's an unrestricted resource when you earn it. You can use it for any purpose. Then we get to sales and services. You can ignore the patient care. My understanding is you don't do anything that would represent patient care, but you certainly do auxiliary enterprises. You have bookstores, you have dining, you have housing, you have parking. Those are all auxiliaries, and they are selling their services, hopefully at a modest surplus. Skip down to educational activities. Anything that happens in an academic department that has value that can be commercialized in some way represents a sales and service. So it could be that you are teaching students how to do lab analysis, and there's a market for the lab results, then people come to see you. Or at another institution, maybe you have a dental school and you teach students how to conduct dental stuff, and in the process of teaching, they need candidates, patients, and they come in and they pay a modest amount compared to what they would pay a regular dentist. That's revenue to you, and it's called sales and services. The last common category are license fees, and the two main ways that we generate those are through tech transfer, meaning that the faculty create or invent something using university resources, and so it's a shared ownership arrangement, and then they usually commercialize it through a third party. And the faculty member typically benefits from it directly, and the institution benefits in the form of license fees. The other type of common license fee is for athletics logo. And so you've got the Titans, it's your mascot, all those things. You commercialize that by granting the authority to print up goods and materials with that on it. That's license fees. The next category is other, which is not an official category, but every time I turn around, there's a new form of revenue that doesn't fit in one of these. The last one I remember firsthand was when the first time at the University of Louisville, we allowed an entity to put a cell tower on our property. And it wasn't an endowment situation, it was just property that the university used programmatically, but we charged them a fee to put it up, and we charged them an ongoing fee to use it. And it didn't fit in anything else we were doing. So that went into my other revenues. Expenses can actually have even more categories than I just described for you, but there are some primary categories that we want to talk about. There are two broad categories that give you a way to look at expenses from two different directions. The first one, we call it natural classification, and that is that it's a natural type of expense. And they're not unique to higher education, they're incurred everywhere. So A natural type of expense would be compensation, which is salaries, wages, and fringe benefits. My other example is travel, but supplies, utilities. It's what is the type of expense, what is it for, and anybody would have that. So if I look at the university's operation, I can see a really big number for compensation. What I can't tell is, well, are those salaries for instruction, or are they for institutional support, or are they for athletics? I have no way of knowing if I do natural classification. The way to find out what's being supported is to go to the second category, functional or programmatic. And we have a standard set of categories. I gave you 2 examples here, but I'll show you the whole list. Educational in general is differentiated from some other things that are on the next slide. Educational in general, these, I think it's 8. 1, 2, 3, 4, 5, 6. Yeah, these 8 categories are universal in higher education. You would recognize that most community colleges don't do a boatload of research, but that doesn't mean they do no research, and they would classify it that way. We have institutional support, which, if we're talking about faculty, again, it's a category that they're not real thrilled about. That's the general overhead and administration of the institution. And every dollar that goes in there is not available to support the academic mission directly. Student financial assistance. Most of the financial aid that you award goes to offset tuition in your financial statements. But if a student, particularly at a school like this where you have a lot of commuter students, is entitled to a full financial aid award by Pell and maybe other sources, such that you're writing a check to the student, then you actually record it as an expense and show that. The next category, now again, this is educational in general. These are your primary missions. The next category are the others, and the first one is auxiliary enterprises. So we talked about auxiliary enterprises revenue, now we have the expenses. Second category, hospital, not relevant to you, but it would be if you had a hospital. The third category is relevant only for about 15 institutions in the country, but it's really big dollars. It's the federal labs that are housed with campuses. Think Livermore, JPL, Argonne at Chicago. Massive amounts of money flow through them. They are affiliated with the university, but they are not considered primary missions. So they're outside and they're considered independent operations. The university that houses, that is affiliated with them is responsible for their operations, but it's not considered part of the university. And again, same sort of thing. There's an other category because people keep dreaming up new things to do. Sir?
On the educational expenses on the last slide, are those items meant to be mutually exclusive, like on a spreadsheet where you're doing accounting, or are they not necessarily mutually exclusive for decision making?
So the question is, is this list mutually exclusive for accounting purposes, or could they be for decision information too? It's actually both. So this is the prescribed presentation, but I'll give you an example of a deviation. Fullerton takes a number that normally would be reported in here as a functional category, operation and maintenance of plant. Your depreciation and amortization, you pull it out and show it as a separate line item on this schedule. Nothing wrong with doing that, right? What gets wrong as a counter to that is when you collect, like if you were to take instruction, research, and public service and just call it academic endeavors, that would be wrong. That would not be allowable under the rules. But what I would say is, the answer to your question is we're driven to do this for financial reporting purposes. What we would want to do for decision support is modify that and erase some things differently. So, but it's we definitely report it this way, but we would manage differently. Ma'am.
Under the rules, what rules are these?
It's called the Governmental Accounting Standards Board.
And all universities follow them?
All public universities have to follow it. For private universities, it's called the Financial Accounting Standards Board. So public universities report their financial information the same way that state and local governments do, which doesn't really make sense. And colleges and universities that are private, they do it the same way that corporations do it. So if you look at a for-profit college and university and a not-for-profit college and university, their financial reporting looks exactly the same. But if you compare a not-for-profit college or university with a public college or university, it doesn't look exactly the same at all. And they call the same things, they use different terminology. And sometimes they use terminology, but they measure it differently. I mean, they really messed things up a number of years ago, and it's never been fixed. It is very confusing. And I'll tell you about this in a little while, but this idea of We have budget rules that we create ourselves. Now, you're a public institution, so CSU might create certain rules you have to follow, but by and large, you decide on your budget rules. You can't decide on your accounting. There are some accounting principles that you get to, you decide at what point you're going to treat something as an asset versus an expense. If it lasts at least 1 year and it costs a minimum amount, you're going to say, we're not going to treat that as an expense like we would your salary for the year. We're going to capitalize that and depreciate it. You get to make that type of decision. But what you call instruction versus what you call academic support, there really isn't a lot of latitude on that. Okay. I need to talk for a bit about enrollment management because it's such an important consideration. Enrollment management, so you understand what I'm talking about, it's a process that's carried out by a group of entities on campus that's focused on attracting, serving, and retaining within your budget limitations the optimal student body that's consistent with your mission, vision, and values. That's what enrollment management is. And so 2 offices are primarily responsible for, oops, whoa, I went really fast there. 2 offices are primarily responsible for attracting students, admissions and financial aid. And then you've got academic and student services, and to a lesser extent the business office, that are primarily responsible for keeping them here and clearly for serving them. So most academic institutions are somewhat dysfunctional in this regard, and you are as well. So I asked how you're organized to manage enrollment management, or to organize enrollment management. What I was told is financial aid and admissions kind of report together, but nobody from academic affairs is involved in that process formally. That's crazy. Because the reason students leave when it's not because of finance, it's either because of what's happening academically in the classroom or the lab or in the library or wherever, or it's what's happening or not happening in the co-curricular areas. So the idea that you would not have this be more holistic and have a true chief enrollment management officer that is taking into consideration admissions, financial aid, not all of that. By the way, I'm not suggesting the provost be the person doing this, but I think it would make sense to have an associate or a vice provost or a director who is specifically responsible for helping ensure that you're retaining students that can be retained, and being the person who goes and talks to individual faculty or individual departments to say, we need to do a better job of keeping our students enrolled. We're doing things that are causing students to leave that we think we can manage and prevent. And that just doesn't happen in enough institutions. Nobody should be comfortable thinking of higher education or a university as a business. But there is one principle that applies to business equally well in higher education, and it's this thing. It's more cost effective to keep a student you have than it is to find a new student to replace them. So your mindset should be, what can we do to ensure we don't lose students? And I'm not saying it isn't that, but you're not organized to that end. You don't have explicitly academic affairs and student affairs involved with admissions and financial aid. And I think that's a mistake. I think that's a recommendation I would make to the university. The other thing that's worrisome is we devote so much attention to trying to get students, so much more attention than we devote to trying to keep the ones we have. It doesn't make sense. Finances are a consideration. We lose some students because they run out of money, and financial aid gives them as much emergency funding as they can, and it just flat isn't enough. They've exhausted every resource. That unfortunately just happens. But one of the realities that, and I want to share with you where a faculty member disagreed with something I said. My experience across higher education is faculty want to teach the best and the brightest. That's what stimulates them. They enjoy doing that. And I used the example in a presentation I gave earlier this week, and I said, faculty would like to have the Stanford students over here and be able to teach them. And the person disagreed with me and said, I'm not sure I agree with that. I think we were really committed to teaching first-generation students, and that we embrace that as part of our mission. So I countered with, he's made an assumption that first-generation students can't be the best and the brightest, so we had a nice little dialogue about that. It was kind of fun. I'm serious. It was a good, meaningful dialogue, but I made the point that I'm not excluding first gens from best and brightest. However, I was trying to make a flippant point about Stanford. So the reality is, faculty want the best students they can realistically get given your resources. Admissions has targets that they must meet. The challenge is when that leads to conflict because faculty feel that the students that are being recruited aren't qualified to be in their classrooms, and it's having an adverse impact on their teaching efforts. So there needs to be that alignment, that coordination to ensure that you're getting the students that make sense for you and that the faculty are able and comfortable to work with them. The other thing that I want to highlight is being very coordinated or overly stop that. Overly simplistic. You have low-cost programs, you have medium-cost programs, and you have high-cost programs. Admissions responsibility, working with input from academic affairs, is to ensure that you're not overfilling high-cost programs before you've filled low-cost and medium-cost programs. Because if you excessively fill high-cost programs, especially if you exceed the cap on how many you can afford with one cohort, then you're going to create a second cohort, which means more faculty, more space, more equipment, all the things that you need. And if you haven't filled the low cost and the medium cost, you don't have the net revenues to support that. So you really need, now someone told me in my previous session that you're going soon to college-based admissions. And it won't be a central decision at the undergrad level, it'll be decentralized. Maybe that will improve things because certainly the high-cost people will know what their limit, what their cap is, and they won't just be worried about admitting students, they'll be worried about admitting the right students and stopping until they get permission to go further. So you do have enrollment targets, that's something that's apparent. But my point is, you need to get more, not you, the university needs to be more sophisticated about enrollment management. Because keeping students, well, by the way, failing to keep students is so costly because if you're lucky enough to recruit them back, it's more costly for them. So it hurts your reputation and it hurts you in tangible ways. So here's what we're trying to do. We're trying to arrive at our vision while adhering to our values. We're trying to get better at what we do, but we can't just get better. We have to get better in very specific ways. I've mentioned this throughout these presentations. I've been a consultant helping institutions for 25 years. I fielded hundreds of calls from colleges and universities that seek my assistance, and not one of them contacted me because they wanted to get worse. Everybody's striving to get better. Everybody's trying to be more competitive. Everybody wants to get more out of their resources. But you have to do it in accordance with your to maintain financial equilibrium. And there are 4 components of it. And by the way, you're in financial disequilibrium, but so are most other institutions. So the first requirement for financial equilibrium is you have a balanced budget. Kudos to you, you maintain a balanced budget. That's good. I'm going to skip over the second one for a minute. You also need to preserve your physical assets and your technology infrastructure. You need to take care of what you've already built and bought. And finally, you need to take care that you can keep supporting your endowment in perpetuity. So you've got to balance so that you don't spend too much today and you don't have enough to spend down the road, nor should you be spending too little today and not supporting the purpose for the endowment and saving it for a rainy day down the road. That's not the way endowments are supposed to work. The problem is this middle one, develop and nourish human capital. I can't tell you how many times I've heard a senior leader in higher education say, our people are our most important resource or asset or whatever terminology they want to use. And my first question for them is, then why do you treat them so poorly? Why do you pay them so poorly? Why are your benefits programs so substandard? Why do you not invest in their professional development? Because we don't. We don't. I've said this in each of my sessions. I was on campus for 20 years. I was always in a mid or senior financial position. I was always allowed or encouraged to go get professional development at least once annually. I never once shared a room with another colleague. I always had a private hotel room. Not that dramatic, right? But every research institution I worked at, people had to share rooms to be able to attend their professional meeting, faculty in particular. And so it's very common for faculty to be lucky enough to get the registration fee covered, and if they're presenting a paper, to maybe get a little bit of support for travel. But it's much more common that they work on it out of their own pocket, and they, in order to save costs, they line up another person that they can share a room with, in some cases 2 or 3 people in a room. I'm just saying, if we're really serious about supporting people and valuing people, that shouldn't be happening. And if you compare us to many other industries, the one I like to cite all the time is healthcare, because they spend way more per person on professional development than we do in higher education. And darn it, that's our business, training and development and education. And yet they're doing a much better job than we are. And it's pervasive across, and this is not just an institution like Fullerton. There are some elite institutions who do exactly the same thing. I've met 20-year employees who got to go to a program in their second year and they've never been to another one since then. There's something wrong with that. So if we really value our people, we should pay them better, we should have better benefit programs, and we should invest in their continuing development. Some of it can be done on campus too. This is an investment, not an insignificant investment, but I'm probably going to train 200 people this week. That's it. So what about all the others? Now, granted, it's being recorded, so someone will watch it. But my point is, there's hundreds of other employees who need to be developed. Maybe they don't need to understand the budget, although I would argue they should. But my point is, this is a problem for higher education. Other questions? Any questions? So you're supposed to ask questions so I can take a drink. Okay, well, I'll keep going. Oh, thank you.
Maybe just a comment. I've always found it interesting that when you look at K through 12, there's required professional development. Am I wrong?
No, you're absolutely right.
Right? And we have none.
Yeah. That's
gonna magically
so.
get.
So I'm going to repeat that for the recording. Is this idea that K through 12, which is the precursor to what you folks do, not only has a requirement, they do it in service. Everybody is exposed to it, and they occasionally will send people off to conferences. There are organizations in the K through 12 sector that provide education and training for teachers and administrators. We have those organizations, we just don't support them very well. So it's a very astute observation. Let's talk about resource management. My belief is not only is planning the thing that you start with, it's the hardest thing, because the toughest decision should be made at the stage of planning. That's when you say, look, you're the most important things we're doing at this university, and we're going to treat you differently than we're going to treat the rest of the university, and you're going to have to be content to know that they're more important than you, and if there's a problem with resourcing, they're going to get first crack at it before you do. That's part of what planning is about, okay? If you do it well, resource allocation and assessment will be relatively easier, but I promise you it will never be easy. And going back to my example, that you're the most important thing here, you give us a proposal that requires X dollars, you give us a proposal for a different amount of dollars, you give us something different, and we say to you, we're only going to give you 75% of what you asked for. You can only do 75% of what you propose to do. We're going to give you 100%, and oh, by the way, we want you to do 120%. We're going to give you more money. Those are tough decisions when it gets to that stage where you're saying, yeah, we approve that this is going to happen, but we also have a limited amount of resources. I've said this more times than I could ever remember. Higher ed does not have the luxury of choosing between good and bad ideas. It's between good and great ideas. And a lot of good ideas that get floated all of a sudden become great ideas because people work together to flesh it out. And we don't have enough money for all the great ideas, let alone the good ideas. So we're constantly compromising and making decisions along those lines. I think it's important when you do effective planning that you're focusing on what you will do and what you won't do. If you're not willing to say what's not important here, then you run the risk that a donor with deep pockets comes in and drives your agenda for you. I will tell you, most development officers do not like saying no. It's one of the reasons that when I was a CFO, gift agreements were not signed by development, they were signed by me as the chief financial officer. Because development will accept any gift. And they accept a lot of gifts that keep on taking. And so we had to say no to certain things, and we should say no. We said no to things because it brought more liability or risk or something like that. But we also said no to things where we said, no, that's not within our programmatic footprint. We don't want to do that. So knowing what's not important is critical. I think all of your resource allocation and all of your assessment should be focused on what you've decided is important. And you don't do things just because they're doable. You do them because they make a difference. So effective resource allocation implements plans. There's an implicit assumption in that first bullet. That is that you've actually created the plans. You have to have created the plans. Second, we will adjust the resourcing based on what we learn through assessment. All right, one of the realities of organizational life, this is not unique to higher education, but the closer you are to the top of the organization, the better off you think things are deep in the organization than they really are, because you do not live that life. So it doesn't happen here. Your president and your provost don't teach, but I've consulted to numerous colleges and universities where the president or the provost or both teach one class a year. I guarantee you they've never been assigned a classroom with a broken smartboard. Not once. Doesn't happen. They've never been assigned a classroom where if you get a bad rainstorm, there's water leaking down the wall. Just does not happen. So in their defense, they don't live the same life that each of you lives. It's a different world. Now, they're not naive enough to think that everything works perfectly, but it's not in their face the way it is for you folks on a day-to-day basis. The second thing is, it is very hard to find people who will tell you the truth when you need to hear it. So I noticed there's a sign, or I'm sorry, it was in the student newspaper that your library had to close because of flooding. I don't think you can keep that from the president, all right? But I would assure you there are things that are happening in Ron Coley's area, in your provost's area, in the student affairs area, that the president doesn't know about, and each of those people is hoping to God he doesn't find out, right? But they also accept the responsibility to go and tell him, look, we're not doing as good a job in this area, and it's really coming to light, and we're going to have to do something to fix it. Good, effective leaders will do that. There are many people who don't have the courage to do it. So I cut a little slack to executives for not knowing what they don't know. But I don't cut them any slack if they don't take steps to ensure that you get that information into the process. And the only way you're going to do it is to have an inclusive process where you bring in line faculty, mid-level managers, and staff and say, let's work together on this. This course is not about this, but I will just tell you, I believe that every institution should have an institutional effectiveness committee that is overseeing planning, resource allocation, and assessment, not 3 separate committees. One committee, because that's how you get alignment. And then it reports and makes recommendations to the senior leadership. I think that's the most effective model I've seen, and I've seen it replicated in multiple places. So this bottom-up knowledge and realities will prevent you from making mistakes. Won't guarantee that mistakes won't be made, but it will prevent the ones that are preventable. I want to talk about measuring consistently, and I'm going to use a visual for this. So when I first became a CFO, I had the responsibility. It happened that I started the job in the spring, and we had finalized our budget, and I had to present it to the board to have the initial budget approved. And I went into the board meeting, I walked through the budget in my presentation, they had copies of the budget. By the way, that was an institution that did planning before it did budgeting. So they had the plan that they had already approved, now they had the budget to support the plan. We went throughout the year and things changed, so we were making adjustments to the budget. If we changed the bottom line, I had to go in and get the board to approve that. By the way, this institution is a public, formerly municipal institution. Their board met 10 times a year. 2 months they didn't meet, but 10 months they did meet. All right, get to the end of the year, they'd seen the last revision, whatever month it was, and then, per past practice, it was my job in the fall, after we received our audited financial statements, to get the board to accept the audited financial statements, which is the last step in the budget process. Well, the budget that I was presenting them every time I needed to looked like this, okay? That's the format it was in. When I would go in the fall and I was going to get them to approve the audited financial statements, it looks like this. And so I'm realizing, wait a minute, we're asking them to accept and saying to them, we fulfilled our plans via this budget, but we're using this to tell them to accept that and believe it. And I said, that's not acceptable. We need to be consistent. If I'm showing them a budget this way and I'm asking them to approve our audit, then I have to do all the work in between to help them understand what the differences are. And remember what I said, there are no externally imposed, except for CSUs, there's some that I'm not aware of, but there are no externally imposed rules related to budget, but there's a boatload of them for financial reporting. This was dictated, this was not. So I could take our final approved budget and show them all the adjustments that we had to make to translate it into financial statements. And I think absolutely that's what we should do. I think we shouldn't change our measuring, change the standard when things go bad. There was a movement in 2009 and 10 in higher education among chief business officers to try to get the financial health standards relaxed because our scores dropped so badly. And my attitude was, I wrote a letter of opposition and I said, why would we do that? That's the reality. We've been measuring against the same benchmarks all this time, and we've been making progress until now. But it's a reality, and we need to build back to where we were. If we fake it, we won't have any motivation or incentive to do that. And by the way, the standard setters didn't change it. I also want to talk about the idea of accountability versus control. So I don't know if I mentioned it in here. I work for 2 public universities, a private university, and a school of fine arts that was private. The one common denominator at the public universities is that we were subject to massive amounts of laws, policies, procedures, standards, regulations, edicts, proclamations, and they all shared one thing in common. Every one of them came about because someone screwed up, and we were going to try to prevent that from happening again. And we know it does not work because people are going to screw up. And so instead of striving for a control environment where we're going to prevent mistakes from occurring, let's have an accountability environment. An accountability environment starts at the top of the organization. And it goes right down to the lowest common denominator across the organization. I don't care what your job is, accountability can work at that level. And essentially what it says is, this is what our expectation is. This is what we want. And we're going to tell you what we want. We're going to support you to provide that. We're going to resource you, and we're going to train you. And then we're going to send you out to do good work. And we will check on you periodically to make sure things are going well, because we also have the consequences under accountability. So let's say you do spectacular work, and we've come to do the assessment, and we realize that, and within the constraints of what we can do in a higher ed environment, we're going to reward you, or at least recognize you for having done spectacular work. And then on the other hand, if we find some things that aren't working exactly the way we want them to, we're going to intervene. We're going to find out, is it because you don't understand what we expect? Is it because we didn't resource you or train you or support you? What's the problem here? And when we find out what it is, we're going to remediate that with whatever it takes. But then we're going to come back a little bit later, and if in fact the improvement hasn't been realized, then we're going to impose sanctions. And so sanctions can take many forms. The most significant sanction we can do in higher education is remove someone from employment status. That's the ultimate sanction, is we've decided you will not do what we need you to do or cannot do what we need you to do, and we can't continue to employ you. But there are other sanctions. When I became the CFO at a university, the second year I was there, we had 2 academic departments that were routinely really getting us in trouble from an audit standpoint or overspending. And the president wanted to know what I planned to do about it. And I said, well, we've added training, we've tried to give them resources, we've linked them with departments that operate effectively, and for whatever reason, we can't get good performance out of them. And he called the deans and said, beginning now, those 2 people do not have it's 2 different schools, those 2 people do not have the authority to approve expenses. You will approve the expenses in their departments. So faculty, by the way, this is the days when things had physical signatures. Faculty had to traipse across campus to get to the dean's office to get an approval to go on a trip, or to get reimbursed for having taken a trip, or to buy a piece of equipment. How long do you think those 2 people survived as chairs? They didn't make it to the next year. They stayed at the university, of course, because they had tenure, and they were in their labs, they were in their classrooms again, but they did not have any authority, and a replacement, either an interim chair or a chair, was identified to do it. That's a form of sanction, is taking someone's authority away. So I try to illustrate this by saying that, I've been in higher education for 43 years. I think I've met 10,000 people. I'm just guessing. Among those 10,000 people, 5 of them were malicious. And I can tell you who 3 of them are. I can name them. I'm guessing there might be 2 others. Why would I create systems to deal with the 5 instead of creating systems to deal with the 9,995 people who I absolutely believe come to work every day, caring about what you do, supporting what you do, wanting to do good work, and not needing to be overseen and micromanaged? And yet a lot of us, and especially in public institutions, that's the mindset, is we got to prevent mistakes from occurring. And all it does is prevent good people from doing their jobs well. So really, that's a message. Stop with this control stuff. It doesn't work, number 1. And number 2, you drive good people out. Role of the budget. I just want to go through this pretty quickly. I think I've used this term with this group already. The role of the budget, financial manifestation of your plans.
I'm sorry,
That's okay.
That's real interesting, because I think there's a lot of that control versus accountability that goes on, and I think it causes problems just with greater workload and things like that. At the same time, I kind of understand a little bit, because I think liability is that kind of behind a lot of it. but I, I don't really know the details in terms of, okay, if we require, for example, that faculty do all this training, then we're off the hook if anything goes wrong. I'm not sure if that's really true legally, or,
So the question you're asking is, how much of this is driven by concerns about liability if we don't enforce these kinds of rules? I'm going to differentiate. Training, as an example, is not done out of control. It's done out of a desire for effectiveness, and there is a component that says we'll protect ourselves. So I get that. But I'm talking about people who want to establish rules so that they can control because they think it makes them important. And we do a ton of that around. We create compliance roles that no one imposes a mandate for. We decide we're going to do that. So we have a compliance officer for good and legitimate reasons. You do research. You have to have an IRB. You have to comply with the IRB. That makes perfect sense to me because the risks are really good. If you allow someone to engage in human research and you're not careful with what you approve and the standards that they're adhering to, you can hurt people in dramatic ways. So that makes sense to me. I get the need for compliance and I get the need for liability protection. I'm talking about the ones where nobody externally says you need to do this, but you decide you're going to do it. Let me give you a real world example. I became the CFO at the university and I found out that the controller of the university, who was one of my direct reports, had to approve any time someone was going to rent a car for travel. Rent a car. So I had lunch with a faculty member one day, and we were talking, and he was asking me for some variance from certain rules related to his research and how we could work around that. And we were working toward that. And he says, by the way, almost as we were leaving the restaurant, he said, by the way, there's one other thing that really upsets me. And I said, what's that? He said, why does the controller's office have to approve my travel for a rental car? I said, I didn't know they did. He said, oh yeah, it's always been that way. So I went back to the office and I stopped in the controller's office and I said, let me ask you a question. What's the process you use to decide when you approve or disapprove someone's rental car? He said, I just make a judgment. And I said, what information do you have that allows you to know more than the person who's requesting the rental car approval? And what would make you think that they would waste resources that are so limited to begin with by getting a rental car when they didn't need one? And he didn't have an answer for it. And I said, you know what? As of today, we don't approve it. It's their decision. And he resented the hell out of me for that. But it's an example of what I'm talking about. What sense does it make for him, sitting in an office way across campus, to say, you don't need a rental car? Uber didn't even exist and we were saying no, right? It just doesn't make any sense. So I want it to be about accountability and effectiveness. Sorry, my throat's going. I'm going to not try to be too obvious with this mint. Keep in mind, when you submit your operating plan and it's approved, then there's an expectation that they're going to allow you to spend that much money. Some of it will be under your control directly, some of it you'll have to get from the general fund, some from even other sources. That's an implied contract between the administration and the operating units. And therefore, they should not come back and take money away from you if there's a problem. Instead, they should go to reserves. They should maybe spend deficit, whatever it takes, but they should honor their commitments implied by that budget. The other thing about a budget is, not everybody can do this, but I can tell you immodestly, I can do it. If you have a relatively accurate budget and you give me your financial statements for the most recent fiscal year, I can take that budget and project what your financial statements are going to look like a year from now. Because we're analyzing all the ins and outs, and I know what that impact is going to be. I will tell you whether you're going to be financially healthier at the end of the year or not, where you've made your investments and where you didn't make your investments. So it's a really valuable tool. The other thing a budget is, it's an indicator of your tolerance as an organization for risk. If you have a budget that shows the deployment of 100% of your revenues toward expenses, and
here's what I found.
I don't know how I'm going to fix that, but if you have that budget that shows 100% of your revenues being deployed you have an incredibly high tolerance for risk because the likelihood that that budget is going to materialize exactly as you expected is not very high. You're going to have some revenue shortfalls. You're going to have some expense overruns. You're going to have some other events. But the most important reason you shouldn't be willing to tolerate that much risk, I like to use this illustration. Let's say that a faculty member here has an opportunity for a $1.5 million grant, but it requires a $200,000 match. If you've allocated your entire budget, you have to tell that faculty member, sorry, we can't do that. Maybe next year we'll do it, we'll budget it. That makes no sense. You should have contingency in your budget to deal with those types of opportunities. That may be the most important program that that department is ever going to have access to, and you just said, sorry, we didn't plan for it. We can't plan for everything, but we should acknowledge that and have contingencies to support that. Lastly, and this is a reality, a budget is a political document. You can see things in a budget, and keep in mind, a budget by its nature only has a description column and numbers. It has no explanation. But you can look at a budget if you have knowledge of the operation and say, why are we putting so much money into this area? And sometimes you'll discover that it's being done because someone is in favor. Not that that's an important thing to do, it's just that they have some kind of clout. And so you'll almost never get politics out of it, but the more you have it be bottom up, the less likely that's going to occur. The more it's transparent, the less likely it's going to occur. I don't want to take a lot of time because there's a couple other things and I want to leave some time for questions, but these 5 bullets, formula allocations, enrollment ceilings, performance funding, position control, year-end balance capture, are all things that plague public colleges and universities because of state oversight and things that they do. I'm not saying that any of that happens in California, but they are pervasive problems across the country in different areas. The one that bothers me the most of all these is the year-end balance capture, because I've spent a lot of my consulting career helping institutions better manage their resources to create more reserves, to give them more flexibility going forward. And usually we've had state approval to do it, and then when times get tough, the state comes in and sweeps the money out. I think it's unconscionable. So I want to give you a little history. Some of you, I don't know if I'm the oldest person here, but I'm pretty close. The Higher Education Act of 1965 introduced the first major expansion of financial aid. The first federal financial aid started post-World War II when they established the GI Bill to keep a bunch of returning vets coming home to no jobs. So the first set of financial aid served one group, white males, and that was essentially it. Prior to that time, colleges and universities were for the wealthy and the elite. It was not for the masses. GI Bill changed that because of World War II. We went through the whole civil rights movement, and finally in 1965 we passed the Higher Education Act, and it introduced the first major form of financial aid that was available to the masses, the Basic Educational Opportunity Grant, which you now know as Pell. Okay, what that was responding to was a concern about access to education and the ability to pay. And so from the late 1950s into the late 1990s, early 2000s, the question only was people's ability to pay. Could they afford to go to college? And then something happened, and it was really a combination of things, but one of the bad things was higher ed tuition pricing went through the roof. And the question stopped being the ability to pay, and it became the willingness to pay, and a question about the value of a college education. That question had never been asked prior to the 90s. People, I mean, it may have been asked in a certain household, but it was not asked pervasively like it became at that time. And part of the reason are these data. So you can't read it from where you're sitting, but number one on this is high school graduation. That's the value of lifetime earnings. If you get a bachelor's degree, that value of lifetime earnings goes up to 1.66. If you go all the way to a professional degree, you become 2.74 times more earnings over your lifetime than a person who stops at high school diploma. I don't think that's insignificant, but I think it fails to acknowledge that the other thing that happens because you come and get a degree is you become an educated person and you value learning in a way that you didn't previously. So your quality of life is improved pretty dramatically. So I think it's crazy when people question the value of an education economically alone compared to what it means for society. I do have to give you a qualifier though. Some new data were released last month that show that, and I've always known these were averages, but I never thought about it, but it's now documented that majoring in the humanities does not fit this model. And for some humanities graduates, their lifetime earnings are not a multiplier of a high school diploma. I don't have a problem with that at all. I think humanities are very important. What I would argue is if in our admissions and recruitment processes we allow people to major in humanities under the assumption that these data will apply to them. That's my only reservation about that. So I think admissions people need to reflect those data in the information they share. Your information on your website complies with the federal rules and it's all averages. So just recognize that there's going to need to be some changes because of these data. My assumption, I didn't read the research study, but I read about it, and my assumption, I know it was done by credible people, so I'm assuming they use good methods, but it's a little worrisome. Complicating your lives are 12 federal agencies and departments that think there's nothing better in life than to make new rules for you to comply with. Everything from, yeah, this is truly the dirty dozen. Some of this stuff makes sense. You know, we should be subject to OSHA. We should be subject to the Department of Labor rules about when you get overtime pay and things like that. Department of Education has to ensure that the billions that are invested are at least used legally, et cetera. I get all that stuff. But if you go back, for instance, to when EPA first recognized the need to regulate higher education, and they decided to literally apply the same regulations they applied to chemical manufacturing plants to a college, a community college that had a few chemicals in a lab, that's crazy. And too often they don't differentiate. They don't consider the magnitude of things. So I'm troubled by this. States put way more money into higher education than the Fed does, and yet the Fed is the big stick person. This is your economic environment. You're subject to all of these things. For those who can't see it, sustainability, changing demographics, pace of technological change, lack of governmental financial support. This is the world in which you live. And all of these make your job harder to do. This just demonstrates that we are 12 years after the Great Recession and we still have not caught up to where our funding should have been if we had not had the Great Recession. Accountability and performance, there's so much pressure on you. There's so much pressure on the accreditors. The accreditors in turn put the pressure on you. And so you're constantly having to look outward to stay out of trouble as opposed to look inward to do the best job you can. I want to just spend a minute talking about the pandemic because it's remarkable. I mean, we talk about what a great job higher ed did responding to it, and I think it's absolutely true. The transition to virtual learning instead of in-person learning, if we'd mandated that, we'd still be debating if it was even possible. And yet you did it in 2 to 3 weeks or something like that. It's a remarkable achievement, okay? But it came with an unintended consequence when the federal government decided to provide stimulus money, because what's happened is significant numbers, I don't mean hundreds, but significant numbers of institutions are surviving who should not exist. 500, 600, 700 FTE student enrollment populations with no endowment, very limited resourcing to provide education, are graduating students who are not well prepared to enter the workforce or to continue to graduate school. We are overbuilt in that regard, and I know it would be devastating for the community, devastating for the individuals, the faculty, the staff, and the students if that institution ceases to exist, but I really think it's a problem. The Fed's stimulus money has allowed these institutions to prolong their death, and it's not in anyone's interest for that to happen. This is important, and I've got about 5 minutes. I'm going to cover this, and then I'm going to go on to another slide. There are 4 comprehensive budget models used in higher education and 2 special purpose models. The 4 comprehensive are RCM, which is not really relevant here, but RCM is a model where the revenue generators, the colleges in particular, own all the revenues they generate from whatever source, and they become responsible for all their costs, both direct and indirect, and on top of that, they pay a tax to the central administration, all right? What makes it so attractive, it's the most popular model to switch to for those institutions that are large enough and can take on the complexity. The reason it's so popular, it's the only model that will sustainably grow the revenue pie. Every other model is just a different way to slice the pie up. It's the only one that increases revenues. The one that you rely on primarily, not exclusively, but primarily is the incremental or historical model. I'm a big fan of history, but not when it comes to budgeting. And incremental and decremental are basically an admission that we don't really value our planning. Because if you're going to treat everybody equally, after we've said this is our most important thing, we've just said we lied when we said they were important. And so many institutions do that. The third one is one that I can, oh, by the way, why is it so popular? It's because it's easy and it's deemed to be fair because everybody's treated equally. That's not fair. This is not a democracy. So it's a bad idea. There are two inherent flaws in incremental or decremental budgeting. The first flaw is that it would be inconceivable that this is the best deployment of resources across the institution because it's just a legacy of all kinds of decisions that were made decades ago. If anybody has exactly the right amount of resources relative to the whole, it's an accident. It is not by design. But the worst part of it is you're going to make decisions now under the theory that if I give you X percent additional, give you X percent additional, give you X percent additional, that's the optimum utility for the institution. And if we reverse it and say we talk about decremental now and say, I'm going to impose X percent cut on you, X percent on you, and X percent on you, and for the two of you, it just means that you're not going to buy some equipment, you're maybe not going to go to a conference. For you, it means you have to cut a position. That doesn't make any sense, folks. So I understand why incremental is appealing, but I think it needs to be done away with, and I think we need to do our budgeting based on our planning. Now, the one that I also like that's really as easy as incremental, but it is ineffective unless it's kept up, is formula. With formula, you divide the resources into specific categories, and you say this bucket of resources is going to be allocated based on a particular metric, and the metric might be number of employees. It could be number of students served. It might be number of student credit hours generated. It could be the amount of space you're responsible for. There's any number of legitimate metrics. When it's operated that way and the formula is regularly adjusted to take into consideration policy implications and changing circumstances, it's an optimal way to do it because it's just as easy. You know, the joy of incremental is if you can operate an Excel spreadsheet, you can create a budget because it's just multiplying formulas. But this literally can drive the distribution of resources. Zero-based isn't real. It's talked about. People claim they do it. Nobody does it. And it doesn't make sense for higher education for two reasons. Tenured faculty is the first reason. You can't say, well, assume zero. Sean, I don't know what department you're in, but let's just say for the sake of discussion, well, we're not going to have your department anymore unless you rationalize it. So he's going to tell me, well, we need this many faculty to achieve this level of performance supported by this level of resources. If you want better performance or more performance, we need this level. If you want us to increase quality, we need that. The reality is we can never be down here because you've got tenured faculty in the area and we're never going to do away with them. So it doesn't make sense, and there's a massive amount of work that goes into rationalizing each of those levels. So it really isn't used in higher ed, but some people claim they do it. The two special purpose models are really different flavors of the same thing. There is something important to us, and we want to resource it to accomplish things. So with initiative-based, we say, look, let's just say for the sake of discussion, DEI is really important at the university today. We have all these objectives we're trying to achieve. We have put aside a pot of money, and you come forward with plans of things you want to do to help improve our DEI situation. And we will evaluate those and decide we'll fund the ones that we think have most merit. Then we'll evaluate what you accomplished and see if you met the mark. And if you did, we might give you more money. If not, we may take some of the money away and move it to something that we think will be successful. In performance-based, it works in reverse. Performance-based, we say we have DEI objectives. You will compete for the resources by pursuing things with your money. And if you're successful at the end, you will have access to the pot that was set aside for those who succeeded. So you might just say, okay, we did all these initiatives. You folks did the best job, produced the best results. You divide up the pot of money that we reserve for that. The problem in particular with performance-based is as soon as you change the performance objective, people stop making the investment to achieve that objective and you're no longer doing it. Initiatives-based tends to be focused on a way that you create sustainable growth or sustainable improvement. The point I want to make is this is true for almost every institution in the country. You don't use one of these, you use multiples of them. And Fullerton is an example of that. Fullerton has a hybrid model that is predominantly incremental, but you also do some things formula, and you do special initiatives funding. So you have a mix. I would just urge you, and I have, to de-emphasize the incremental and to refer to plans. There are 16 steps to a formal budget process at the institution level. I'm not going to go through them, but you can read them real easily. They're on the slides. They're very self-explanatory. The book talks about how you actually do it. There are 2 slides that are still important if you can spare your time, but if you have to leave because you've got to get to a class or whatever, just please do what you have to do. You get a sense I'm not real fan of across-the-board anything, all right? I think you have to focus on your plans. I think you have to use reserves that you've created. You need to resist the temptation to allow deferred maintenance to grow. Deferred maintenance means that you were planning to replace a roof, or you were planning to replace carpeting or paint or whatever, and because times are tight, you don't do it. There are 2 problems with that. Actually more than 2, but the 2 biggest ones are, 1, poorly maintained buildings are more expensive to operate. Second, when you get around to doing it, there'll probably be more damage and it will cost you much, much more to fix it. And this should be the most alarming for you. Not taking care of your physical, the built environment leads to adverse results for recruitment and retention of students. So you are shooting yourselves in the foot every time you choose not to do something, especially the ones that are visible. I made this point, but I want to articulate it further. Less important programs should take cuts if you're in a budget contracting mode more than the important programs. And for me, that means you need to publicize 2 lists. The first list is the one that you say, if we get a financial windfall, this is what we're doing with the money. The second list, which is the one that really irks the HR people, is when I say, if you've got a list that you know there are areas of the university that you're going to adversely affect if you have a financial difficulty, I think those people need to know that they're on that list. And 3 things can happen if they know, other than getting mad and going to HR. The first thing is that they can just ignore you and say, well, if it happens, and I'll do what I have to do. The second thing they can do, especially the good people, the really strong performers, is go find a job somewhere else where they think they'll be better valued. On one hand, I feel bad they leave. On the other hand, it helps solve the problem, okay? The third thing is that they can be indignant and say, you're wrong, and we're going to prove that you're wrong. And I've literally seen that happen at universities, where with no infusion of resources, people discovered how they were perceived in terms of their level of performance and what they were contributing and said, we're going to change that. They never would have changed it but for knowing they were on the list. So I think if you have that, first of all, you should have it, but you should share it. And there's nothing wrong with getting off the bottom of the list. It may mean you have to go higher up on the list to achieve a target, but if you're down near the bottom of the list, you should know that and be given a chance to get off the bottom of the list. I mentioned I know a little bit about assessment. With accountability, what gets measured gets managed. So only measure the stuff that you deem important. I talked about predefined measures. I want to talk about outcomes for a minute. Inputs and outputs are relatively easy to measure. They aren't as meaningful. Outputs are either a productivity measure or an efficiency metric, but they are not indications of impact or value. Outcomes are impacts of value. That's what we should be looking at. Avoid easy to calculate, measure consistently, but the most important thing I can tell you is don't engage in assessment unless you're prepared to make decisions based on what you learn. Because keep in mind, if you engage in assessment and you learn something from it, people know you know it, and if you don't do anything, you've lost credibility with them. This is the end. We're over time. I apologize for going over, but I appreciate you coming. If you want to read the book, if I didn't say it, I don't get anything from the book. I was paid a commission to write it, and they decided to buy it. But they have a number of copies. Just let Jofel know, and she'll put your name, and she'll send you a book. And we just ask that you return it so others can read it. So thanks for taking time out of your schedules to come, and I encourage you to attend the other programs as well. See you around. Thank you.